Hi, I'm Neil Carstairs from Mortgage Corp, your property investment mortgage specialist. Today we're going to do a really quick video on equity. What is equity? How do I use equity? How do I get access to equity? Equity is our mate, equity mate. Our equity is the value of our property, in this kind of scenario, a $650,000 property where we owe $350,000, we have access to $300,000 in equity. We get a lot of clients that ring up and say, I have a $500,000 property, I've got $1 million property, I don't owe any money and I want to take out just 200 grand or 300 grand to go buy an investment property or some shares. The biggest rule that we need to apply is one of the 5 key factors of credit: capacity. Capacity is how much can I borrow based on my income. Income is determined by pay slips, tax returns, and rental income. In this scenario, we're going to show you how a client was able to access equity from an existing property to help purchase an investment option. There are 2 ways to do this. Either one, we use the existing equity in the property and we borrow potentially 100% of the new purchase. How do we do that? We have the value of one property plus the value of the second property coming to a total amount of $1,050,000. We have a loan of $350,000. We need to borrow $400,000 plus stamp duty, which is $420,000. Therefore, the asset value, plus the $350,000 is $770,000. We need to borrow $770,000 over $1,050,000. So our LVRs are still under 80%. That's a ripper. This gives us access to being able to borrow and use equity in an existing property to cross-securitize. Some clients, and we determine on a case-by-case scenario, whether it's actually beneficial to do it this scenario or get access to equity of 20% and do a split. How do we do that? We then have a loan of $350,000 based on your capacity of either your income plus proposed rental income. Remember, we are actually taking into account the rental income of the new property. Okay, so even though you're not earning it, the loan is approved or subject to how much rental income we can get on the new purchase plus whatever income you're earning here. These 2 scenarios of using equity is either using cross-securitization, which if you Google has a lot of bad information written on it, but there's also the positive side where it actually enables you to structure your loans with one bank and have 100% borrowing and increase our borrowing capacity. When we start splitting up loans to different lenders for better rates, it actually decreases our policy, decreases our potential to borrow money depending on the bank's policies. Some banks don't like you having lending with other banks, and it's not that they don't like it. They actually have rules in place. They put buffers on repayments. They don't use negative gearing. They only use potential rent at 75 or 80%. And all of these factors will assess when trying to access equity in an existing property when purchasing another investment. So the second scenario is we already have a loan of $350,000. We're looking at a second loan for 20% plus cost of the new purchase, because we like to keep our LVRs around the 80%. It's not that it's a rule or you have to. In this scenario, because you have access to good equity, it's actually worthwhile not paying mortgage insurance, and that's a good thing. If in some cases you do have to pay mortgage insurance, well, so be it. If you don't have any other options, but you can work out your cost basis that it's actually going to put you in a better position in the future, sometimes it's worth considering. But getting back to equity, the second loan in this scenario, we need to borrow 20%, which is $80,000, plus the stamp and cost, in this case is $20,000. We need to put a second loan in this scenario for 100 grand. We'd set this loan up with P&I, so principal and interest payment, so you're paying this one off. This loan could potentially be interest only, depending on how much and how much money you can borrow and for how long we need to do it for, whether it's 1 to 5 years. Generally, we try and take as much as we can on the interest only for an investment. Then over here, we would set the new loan up. So we would have another loan number 3, which is actually for the new purchase at 80% of $320,000. Again, preferably interest only on an investment because it helps with cash flow. Obviously, paying principal means your payments are slightly higher. Again, 1 to 5 years. So this shows us that we have using our own house plus the new investment and keeping it separate. In this scenario, we show you how to use equity and cross-securitize to borrow 100% on this side, actually 105% to purchase the new investment. The only concern we have in doing the top scenario is generally if you don't have any savings, then you don't have a deposit to give to the agent. Now, we can get around that with deposit bonds or deposit guarantees, either through a bank or through one of the other institutions. But generally, an agent wants their deposit because that's where their commission comes from. If they have to chase the bank or the solicitor for it at settlement, it just gets a bit iffy. So ideally, we would need to look at structuring it either doing a top-up on this loan and doing a split, and then restructuring the loan at settlement of the new purchase. So this gives you an idea of how we use equity in advancing ourselves to other investment properties along the way. Now, over time, this property will or potentially has the potential to go up in value. If that goes up in value, it creates more equity. Again, gives us an option to looking at future investments. So this is an overview of equity. I'm Neil Carstairs from Mortgage Corp. I hope you get as much information from us as you possibly can in making the right decisions in going forward on your investment strategies. Neil Carstairs from Mortgage Corp, your property investment specialist.